But do you agree that those
No,
waiting on a Fed pivot should probably reset their expectations?
no. You have to push that date, pretty far out now, because two things. First of all, is that I'm actually running a chart. I'm about to do an article on why the first two quarters wasn't a recession and why it's still coming. And one of the charts I've got in there is that if you're running inflation data and looking at, so what we're looking for is the year-over-year rate of change. That'll lead to the decline in the inflation data, right? So if we start printing 0.5, 0.4, 0.3, increases on a monthly basis, then inflation will come down. Well, inflation is not going to come down a whole lot by the end of this year. Now, it's going to get back towards target if we start printing 0.3, 0.2% CPI, and we're not going to do that right now, but just assuming that every month going forward from here, we print 0.2% increase in CPI, we'll get back to about a 2% target inflation rate at the end of 2023, right? So it's going to take a while for that inflation to come down. And that's just assuming you get a very low print every month going out, and that's not going to happen. My house sale is a good example. Housing prices make up 42, homeowners equivalent rent, which is a function of basically a call. I call Adam. Adam, what can you rent your house for? Adam says, oh, I can get $10 million in rent for my house. And so, they lock that in, right? So that's homeowners equivalent rent. What do you think you can rent your house for? So, what this is going to do is that, I just sold my house. By the time that housing data shows up in the data, it's a 3-month lag. So, and the same thing for energy prices and other stuff. So a lot of this stuff is lagging data that will take a while to start to filter into the CPI report. So inflation is not going to come down a whole lot by the end of this year. It's going to start declining probably next month, but it's not going to come down a whole lot. And this is going to keep the Fed, geared towards hiking rates. Now, they may do 75 basis points in September, then maybe they do 50 in November, then maybe they go to the quarter, after that, who knows? But, their focus, St. Louis Fed Governor James Bullard out Monday or Tuesday of this week said, 3.75 to 4% on the Fed funds rate. I don't know if you can get there without breaking something, but more power to you. That's what they're going to try to do. And that's the real question is again, they're hiking rates, looking at lagging economic data. And we just went through that some of the data they're looking at is probably flawed. And they're going to hike rates based on that data. By the time that when unemployment changes and you realize that you've got an unemployment problem, unemployment doesn't go, oh, well, we had a print of, -2 people last week, right? It'll be negative 500,000, negative 400,000, negative 600,000. It happens very rapidly. When the economy breaks, it's all at once. It's like a dam. And right now you've got little cracks in the dam. We can see it in a lot of the economic data. And so, yeah, there's some water kind of, leaking through the wall. It's all fine and dandy, no big deal. But when it breaks, it's all at once. And that's what happens with the unemployment data. And you can look at a chart of the Fed rate versus the unemployment rate. And you'll see that what happens is that as the Fed is hiking rates, unemployment is bottoming. And then all of a sudden it does this, right? The Fed's cutting rates and unemployment shooting through the roof. So by the time that you realize there's an unemployment problem, it's too late. It's already broke.
All right. Great warning for people. And I sadly feel that we're going to be tracking the trajectory of those charts in real time over the next couple of months here, and that's exactly what's going to happen. If you enjoyed this video clip, click here to watch another one you should like.